it's fair to say that investors, when you look at various jurisdictions around the world, and I'll get to this in more detail, investors in general receive lower returns, or they share a smaller share of the pie when it comes to mining projects in Africa. I'm talking about Africa in general. Of course, there are various differences between different countries, but overall, that is the case. And that's because of the operating costs, the taxes and royalties, and the way the economics in general is split. The other issue is that in order to resolve some of these issues, I'm going to discuss this idea of a multi-stakeholder approach, because you have many stakeholders in mining projects, and not one of them can be blamed for the problems, and not one of them can solve all the problems. And I want to have a quick discussion on that aspect as well. And the role of government, of course, is key to making this happen. Now, when we look at various commodities, in Africa, you have a substantial amount of some key commodities in Africa that's produced. But again, as I mentioned before, the deals are much smaller. Zimbabwe shares a number of these productions, especially in platinum, gold. Gold is actually more than 50% of deals worldwide in the mining sector. Copper is 27%, iron ore is 19%. But gold is abundant in Zimbabwe, and they should have a bigger share of investments than they do. The good news that I wanted to share before I get to the challenges is that in 2015 and 2016, the investments and the deals in the mining sector were largely driven by reducing leverage and also trying to streamline portfolio. It was less driven by growth. Actually, 45% of the deals done were based on reducing debt. Today, in 2017, that proportion has reversed. So actually, 54%, actually more than 40% of the deals were done for growth reasons. And that's should be music to the ears of mining companies in Zimbabwe, because again, we see that the companies are looking for growth and looking to expand and come into jurisdictions for mining projects. So that's the main reason that we see deals coming through. Now, when we look at Africa, we have to understand that in general, mining is in competition with other sectors in the economy, and within mining sector, there's competition between jurisdictions. So Africa is in fact in competition to get investments from investors, and Zimbabwe is vying in that competition. Why this competition is so fierce? Because there is still cash scarcity. The 2014 to 2016 memories are still there, and there is a big emphasis on being cautious still, and returning to. There are big worries about returning to a high cash cost environment, and there's also again focused on selling non-core assets and, in fact, returning cash to investors rather than investing in projects necessarily. So, and people are still worried about returning to, because it's a cyclical sector, returning to an era where you have a lot of write-downs. So there is cash scarcity in that people are quite cautious in choosing projects. There is a risk aversion, meaning that people are quite focused on margins. And this gets back also to some regulatory points, because government can help in that space, but margins are important. Mining companies and investors do a lot of due diligence. They have been doing a lot more in the past 3-4 years, and that trend is continuing. So the funds are not necessarily flowing to the highest grade assets. you have in Chad, for example, gold that is 27, 28 grams per ton. But that doesn't mean that necessarily all the gold miners are rushing to Chad. So the entire economics and the risks are quite carefully examined. Oops. And the other two aspects I'll get to in more detail is related to country risk that's looked at very carefully, and also this aspect that I mentioned earlier, how to share the economics between the government and the civil society and the shareholders. Now, when we look at Zimbabwe, in the ideal, from an investor point of view, what would be an ideal mining investment, right? Because they have a lot of choices to go around the world and in Africa. Economics obviously is important. When you're assessing your project, if your internal rate of return is below 20%, it's going to be difficult to attract investments from outside. It may not be reasonable or fair, but that's the way we are seeing the market currently. And your assets should really be in the lower quartile in the cash costs for cash costs in operations. Oh, sorry. The other thing is that the profitability and returns have to be there. The management has to be very strong, technically competent. The security issues around health and safety must be addressed. If you are dealing with bulk commodities like coal and iron ore, obviously infrastructure has to be in place. If your project has beneficiation, requires a lot of electricity, access to electricity and so on has to be in place. And also there needs to be quite a supportive community. I mean, obviously mining companies should work hard to show the benefits of their project to the communities that they're working in, but communities should also be supportive. All of that represents an ideal project. To the extent that some of these things are missing, attracting investments would become harder. So investors, usually like to tick all these boxes, and I wanted to share some of these with you. Of course, there's a lot of detail in each of these aspects when we get into economics or dealing with communities. One thing that impressed me is that and I think would impress a lot of investors, is in the area of communities and labor market in Zimbabwe, it has a very high caliber competency in mining sector. And that's one of the huge pluses that I think would attract investments. Now, when we look at the share of economics with investors across jurisdictions, you will see from this chart that African countries are in the lower end of the range. So when you look at the other jurisdictions like Canada, Brazil, Chile, Australia, these are the biggest and most important mining jurisdictions, as you know, and Russia, their share of the total economics that goes to investors is significantly higher. I can show you and this is in the backdrop of the cash costs in Africa, for example, being higher than compared to the rest of the world. So not only the share of the pie is smaller for investors in Africa, but when you look at, for this is an example of the gold sector, we looked at the average cash cost of gold in various parts of the world. This is again average, so obviously projects differ from each other. But in Africa, it's one of the highest all-in cash costs in the world. And there are reasons for that I'll get to in a minute. But when you put those two together and compare it to other jurisdictions, you'll see that in Australia, Canada, and Chile, and these other countries, more than 60% of the shares go to investors that have invested their money. And whereas in Africa, that share is usually below 50%. There are a couple of exceptions I mentioned DRC, although that's changing as well. And actually, these pie charts are not getting better, they're getting worse. I've not put up the pie chart for Zimbabwe because it's evolving and it differs, its policies differ in diamond and platinum and other minerals, so, and it's not yet completely implemented, so I didn't put that up. But if you look at the others, you'll see that they are less, and it's getting worse. For example, in South Africa, there's a new mining charter that's increasing this percentage from 26% to 30% for mandatory for local for local shareholders. In Tanzania, the government has been increasing royalties and increasing the share that the government must retain to 16%. They're doing a lot of other things like removing international arbitration and so on. So there's a number of, actually the trend in many of these countries is going the wrong way. It's important to see how Zimbabwe would then compete within this space, not just in Africa and then outside of Africa. Now, when we talk about mining companies, they have a lot of risks to manage. They have a commodity price risk to manage, they have management risk, exploration to implement their projects. They have obviously operation risks. And there's a lot of market risk in terms of exchange rates and inflation. Whenever you have these kinds of risks, especially on commodity prices and exchange rates, and you see a lot of volatility, it becomes much more expensive to hedge these costs. So all of these things add to risks and costs of the companies. But on top of that, then you have country risk as well. And what I think the role of the government has to be is working with the companies to at least minimize that risk. Because the other four risks, the mining companies are competent or should be competent to manage it. It's much harder to manage country risk in a jurisdiction that you come into, and it's a range of legal, fiscal, political stability, and corruption, and all these other things that you know. So, and I wanted to also stress a couple of things besides those risks in the context of what we have seen in Africa. Some of the costs that we have seen in some of these jurisdictions in Africa, and this is not a reflection of Zimbabwe, but it's always a continuum. So security costs, infrastructure costs, beneficiation costs, productivity costs. This is a continuum from one end to the other. So the less you have of these costs, the better jurisdiction you are. But there are projects in gold mining projects in Africa that require an armed force of 400 persons to protect it. I'm coming from Luxembourg, and the whole army of Luxembourg is 452. So it's like literally hiring the entire army of Luxembourg to protect one mine. That adds to the operational costs. And then also the productivity costs matter. They really relate also to the health issues. In some countries where you have a lot of tuberculosis and so on in underground mining, it impacts the productivity of labor, adds to the operational costs. What I wanted to share with you is also that to align the interests of, this is a busy chart, but basically it shows the interaction between what the investors want in terms of maximizing return and minimizing risk versus what usually the government wants, like it's what Zimbabwe wants, which is enhancing living standards, enhancing stability. So when you go through each of these items, you will see how there could be areas of collaboration in terms of economics. You want to bring down your cost base. The government may want to have beneficiation. In some cases, beneficiation does make sense to retain the value chain. In some cases, it may not, because the companies have to look at the entire cost structure, and if electricity is expensive for the beneficiation or other aspects, then it makes them uncompetitive, and the project will not be viable. So I don't want to go through all these in detail, but you can see how there needs to be a collaboration in terms of all these aspects, developing skilled labor, developing security, health, and infrastructure, and how partnerships can be developed together. There are a multiple number of stakeholders when addressing these challenges in Zimbabwe, and I think there needs to be a much more serious and a deep dialogue between all these stakeholders. To have a successful mining operation without the involvement of all these stakeholders, which are the companies, the government, employees, local communities, and civil society and NGOs, without their involvement, it's very difficult to imagine in the long term mining projects remaining on a sustainable, profitable way. They may be profitable for a couple of years, but then there will be a backlash against them and they will have to leave. And similarly with government, they don't want to lose investments from the country. So it's absolutely crucial that these stakeholders are all participating. The other aspect of this collaboration is both inter-collaboration between companies and government, which we discussed before, but I also wanted to mention the intra-collaboration between countries in a region, because a lot of mining projects depend on electricity, roads, especially on bulk commodities, you need pit-to-port solutions, or if you have high-intensive electricity projects, you need electricity, which may be on the other side of the border. So cross-border relationships, which is the role of the government as well, are going to be crucial to success of projects. We have actually been discussing forming mining cities on border areas that would benefit projects on both sides of the border. I won't go through all these right now because I only have 2 more minutes to close, but there are a number of solutions that need to be discussed. And I know that we have heard this from this morning that Zimbabwe, for example, is going through developing its regulation. What's important is the content, obviously, and the dialogue between the companies and all those actually stakeholders to make sure that the share of the economics is fair and also competitive when compared to the other jurisdictions. I wanted to, lastly, I wanted to talk about how to attract investment. This is something we have been involved with in other countries previously, is how to market Zimbabwe. And I think this morning's discussions by Honorable Minister of Mines and Acting President was quite insightful in that actually they are following most of these recommendations. So it's not only to show that you have quality assets, but to demonstrate, as was stated this morning, that you're taking a strong stand against corruption, against unnecessary bureaucracy, and so on. And you have a clear, simple, transparent, good regulation with fair sharing of economics between different stakeholders. And then to present this plan to the market and to show how you are addressing, how Zimbabwe is addressing all of these issues, as well as community development and safety in society. I think with that comprehensive picture, then there should be a lot of attraction of investment flows to Zimbabwe. Thank you very much.